Good everyone, welcome back to our next edition of Econ Talks. Gareth, we've seen the latest inflation data come out for the second quarter of 2025, and it was a little bit hotter than the Reserve Bank had expected when they first published their forecast 2 months back. 2.7%, actually slightly lower than what the rest of the markets have been sort of worried about. You know, people were thinking inflation could well be starting to get close to that 3% high point that the Reserve Bank generally targets. So it was, I guess, a little bit of a mixed bag looking through all of that. The fact that inflation has further re-accelerated, of course, uncomfortable, certainly at a headline level. There's those concerns that if you see a higher headline inflation, that'll start to influence people's expectations of prices in the future, but also sort of quite a variety of factors coming through that have been driving that little bit more intense inflationary pressure. We've, of course, seen food prices in recent times, often a more volatile category, higher dairy prices. You look at the price of butter, meat, a number of other products increasing, but again, not generally indicative of a more broad underlying trend of inflationary pressures. What else is going on below the surface? How do we sort of read these numbers in terms of them being stronger than we'd all hoped for, but not quite as bad as we might have feared?
Yeah, I mean, you talk about food prices and meat and dairy, vegetables as well going up in price. Look, some of that was seasonal, but when you look at the details, some of those vegetable items, tomatoes, cucumbers, beans, they were rising by probably more than you'd normally expect at this time of year. Electricity up almost 5% from the previous quarter. That was not a surprise given the higher lines charges for both the distribution companies, but also Transpower coming through into your power bill. But that was the biggest quarterly increase since 1988, so a substantial lift there. And also Netflix, TV streaming services, those prices have risen as well. Not everything, of course, was rising in price rapidly. It was a bit of a relief, particularly in terms of petrol prices, down almost 5% from where they were in March. And we also had accommodation prices falling. Again, some of that a bit of a seasonal effect too. Weakness coming through in terms of rents. They're still higher than a year ago, but the rate of increase is slowing. And when you look at parts of the North Island, Auckland and Wellington, those rental growth rates are quite slow as well. So sort of mixed pressures. And I think, you talked about the headline number being a bit higher than the Reserve Bank had anticipated. That was all on the tradable side. On the non-tradable side, which is, domestic inflationary pressures, that was in line with expectations, coming down from 4% to 3.7%. So, look, it's still on the high side, but it is on track in terms of the Reserve Bank's forecast to get down to 3% by the middle of next year, which will be a sort of normal rate of domestic inflation. So you look through all those numbers and, like you say, room for a little bit of concern through there. But generally speaking, things tracking largely as expected. And at this stage, probably nothing in there to suggest that this inflation spike that we're seeing is anything more than temporary. And that's quite different, of course, to the experience we had 3 or 4 years ago when inflation got out of control.
And I think also hopefully different from the fact that, back at that point when you did start to see inflation get out of control, you were seeing quite a general lift in prices. It really was sort of emerging from all areas. I mean, even your point around the likes of your tradable versus non-tradable, again, your non-tradable, the bit that, is often a bit more around the persistence or certainly more influenceable, continues to slow back slowly, but it's getting there. The tradable, the overseas-based inflation, yes, spiking up a bit, but that's also after a period of sort of lower oil prices have broadly flowed through into the numbers. And I mean, you look at sort of what households are having to put up with at the moment, and there are sort of just so many different movements. I found it interesting looking at some of the sort of more core measures of inflation, and there's a few out there. They do seem to be broadly plateauing, and a few of them even popped ever so slightly higher. I think that the challenge there is that, okay, yes, there might be a little bit more residual heat in there, but it's not enough to start to show a broader re-acceleration. I mean, we saw this time sort of quite a shift in terms of the numbers of items that are either increasing or decreasing in price. If you've got more items decreasing and fewer, of course, increasing, does seem to imply a little bit more pressure on some, particularly retailers, I'd expect, who aren't able to increase prices. In fact, they're having to cut them to move stuff out the door. How fair of an assessment is that?
Yeah, you're right. I mean, the stats numbers showed that there was more discounting occurring. I mean, the shift in the numbers doesn't tend to be too large, but when you look through the details, there were several sort of retail categories where they did note that there was more discounting coming through. So that again is a reflection of trying to run down stock, relatively weak demand levels. One of the other sort of key areas where we saw prices fall, and I think this is the first time in probably 15 years or so, was in fact for residential construction or the purchase of new housing. Those prices were slightly down over the quarter as well, and so that reflects obviously weak conditions through that residential building sector, and firms pricing work more sharply. We've expected that price inflation to slow, but to actually see prices fall is very unusual. And so you look at that. I think when you look at the ups and the downs through the CPI over this latest quarter, a net, I think 19% of the index rose in price over the June quarter. And to put that in perspective, that's the smallest proportion of the CPI rising in price since 2014, and vastly different to the numbers that we were seeing through the last 3 or 4 years as well. And you mentioned those core inflation measures. For me, you look at those, you go back to mid 2021, 4 years ago, when we were sort of just in the early stages of inflation accelerating, then all those core measures were taking off. They're not doing it now, like you say. Some of them are a little bit up, some of them are flat, some of them are actually still easing back as well. And so for me, that does reassure me about that assessment that this is hopeful. Well, it does look like it's nothing more than temporary at this stage, and there's not those sort of broader generalized price pressures. From a household perspective, it still feels uncomfortable. You're having to pay more for food, you're having to pay more for electricity, your local authority rates are going to go up next quarter again by a significant amount. And those are all things that you can't avoid having to purchase. They're necessities. And so in terms of cost of living, people are still feeling something of a squeeze coming through there. There might be a bit more relief going forward, but at the moment, it is an issue. And we're seeing that, of course, discussed, not just butter, but generally more politically as well in terms of some of the stuff that's going on. Look, for me, you take all of that together. I would say, in terms of what the Reserve Bank gave us a few weeks ago about future direction for monetary policy, still on track for another OCR cut to come through later in August. Beyond that, we'll be watching some of those partial indicators, I think, in terms of gauging how the momentum in the economy's recovery is going, whether it is starting to build a bit more. If it's not, then maybe there's room for further cuts. But if the economy just continues to pick up and that sort of growth story becomes a bit more robust, then it may well be that there's not scope for further cuts going forward from here. But that still remains up in the air. For now, cut in August, and then we'll see where we go to from that.
Definitely, and I think, like you say, that expectation that the more money that's being unlocked in the primary sector, more money that's being unlocked from people's lower mortgages over time, that is expected to fuel that higher level of spending coming through, and then hopefully, well, from a retail point of view, you don't need to discount to quite the same degree because there is sort of healthy enough, couching that carefully, not strong, but healthy enough demand to keep things going. And again, I think importantly, at the moment, the Reserve Bank also comfortable with inflation at a headline at 2.7%, still wants to see it around 2%. But let's be clear, we're not expecting the numbers to start to head into deflation territory, anything silly like that. So again, need to sort of balance out all the expectations around rates cuts and further sort of monetary policy action, because yes, the economy is still in a tough place, but the Reserve Bank is still concentrated on that price stability, and those two don't always move every second of every day, sort of one-to-one in step. We'll continue to assess how all of that goes in the future, what pricing pressures emerge or don't, as the case might be, how the economy evolves, and how the Reserve Bank responds to all of this on one of our future editions of Econ Talks.